Hi everybody, this is Thomas and I'm here with our market commentary for the third quarter of 2015. Remember that you can pause the video anytime if you want to review the slides in greater detail. Before I get started, I wanted to introduce our new team members. We've sent out an email newsletters that we have added John Conti, Chris Sheehy, and Jacob Mandel. And with the addition of Jason Drought last year, we now have 4 advisors and an office manager. So the new team reflects our growth and our commitment to improve the service we provide our clients. And the quality of these new guys is something special. So if you have time, take a look at their website and their bios. And you'll be meeting them in greater detail later on. Okay, let's take a look at the market for the third quarter. The quarter was volatile, to say the least, and I'm sure you heard in the news and in the media what was going on. And while most advisors have their hands full during this environment, our clients know that we typically do really well during these periods. We had a hedge on for many clients, and the benefit of the hedge was significant, both in terms of absolute return and, more importantly, as a safeguard against a severe decline. I'll go back to this slide. This slide shows that all of the stock components of the market were down pretty significantly, and bonds were up a little bit. This is the graph of the market with the news items that drove the market in both directions. And this was the period August 21st through the 24th where the market went down about 10%. And you know from the news that the Fed, whether they're going to raise rates or not, and turmoil in China's markets were the headlines, but there's always a lot going on behind the headlines. If we take a look at world asset classes, we can see that there were significant declines in emerging markets. The U.S. escaped with moderate declines, and a lot of other asset classes had pretty severe declines. When we zoom in on the U.S. market, declines weren't that bad. The worst performing was small cap growth and small cap value, which is we're underweighted with DFA and our philosophy. We overweight, small cap value, and small cap and other riskier assets do poorly in a decline like this, so small caps getting beat up a little bit. We own it because over long periods of time it beats all the other asset classes, so we hang in there. Then when we look at the rest of the world other than the US, big declines in all the different asset classes as well, and emerging markets was where there was really tremendous damage in lots of emerging markets, and all the asset classes had pretty severe double-digit declines. Then we go over to the countries, and this is a pretty dramatic slide showing even in the developed world, we had some of the developed markets with pretty significant declines. All the markets were down. And then over in the emerging market world, huge declines, 33% for Brazil, 26% for Greece. Greece is in the news quite a bit, Brazil less so, but that's a pretty huge to have a stock market go down by 1/3 in a quarter. I just wanted to mention one thing that refers back to the new team that's on the job now. We basically, this sounds silly, but we basically don't invest in areas that we don't understand well and do the proper due diligence on. That's why we have relatively few tactical trades and aren't coming up with 1,000 ideas and chasing whatever the current trend is. That seems normal and smart to not do things unless you do the due diligence, but it's not normal. Lots of investors and advisors jump on bandwagons without the least bit of expertise. So that's not our style, so we couldn't really jump into country funds. But with the new team, there's a lot of expertise there, and I expect that we will start doing things and overweighting and underweighting country funds and other asset classes with the addition of the new team guys. So we'll keep you informed as that goes forward. If you look at commodities, which we always show, we have a very small investment for aggressive clients in oil at the moment. Oil got crushed last quarter, so that didn't do that great, but it snapped back a lot since then. But this is what commodities did. Fixed income is just really the message on this slide is that investing in a 60% stock and 40% bond portfolio is a challenge these days. as 40% of the portfolio has really low yield. So we can't do anything about the yield, and in former times this part of the portfolio in 2007 was producing 5 and 6% returns just annually. Now that's not the case. So we are going to live with this. And for many investors, there is a great temptation to chase higher returns in real estate or gold or emerging markets or high yield bonds or commodities, currencies, master limited partnerships, or whatever else they can think of. That usually ends badly, as too many people chase riskier and riskier assets, and we just don't play that game. We have high quality bonds and we're accepting the yields, and we're not going out on a limb trying to increase our risk. Hopefully interest rates will rise in an orderly fashion, and savers and retirees will start to get paid what they should be paid. This last slide is an excellent, as usual, editorial by DFA talking about volatile markets and what happens if you try to time the market jumping in and out. Usually doesn't end well. So that is it for now, and I hope you find the material helpful, and if you have any questions, give us a call anytime. Thanks a lot.